Hello and welcome to Fortrade. The subject of today's video is identifying and using patterns in trading. In trading, patterns are chart structures formed by the movement of a price. It is believed that such visually distinctive structures can provide us with a trading recommendation. Patterns are often used for trading shares, because shares are financial instruments that do not often or significantly change their movement direction or trend structure. They can be equally used for trading indices and commodities and for trading currency pairs. But we should keep in mind that they have proven more successful on financial instruments that do not experience sudden changes on a daily level. There are several types of patterns for trading. The most frequently used ones are the following: symmetrical triangle, non-symmetrical triangle, head and shoulders, double top or double bottom, triple top or triple bottom. We will start with the symmetrical triangle pattern. This is the most commonly used trading pattern. It is the easiest one to recognize because the tops and bottoms are increasingly smaller. It is formed by trend lines that get closer to each other. The key elements of this pattern are triangle height, the point where the trend lines cross, and the breakout point where one of the trend lines is broken by the price line. One of the trend lines is usually broken at approximately the 3/4 length of the triangle. Later, if the trend line is broken again, this can mean that one of the trend lines was tested, or it can signal the return of the price into the trend channel, or the possibility that the price will start moving in the opposite direction. The triangle doesn't have to be symmetrical in order to be relevant for trading. It can also be asymmetrical in both directions, without being a right-angled triangle. Breakout can occur on both sides. However, a trend line with a stronger inclination often offers stronger resistance. Also, occasionally after the breakout, the triangle can get tested. In other words, the price can return towards the trend line, bounce off and continue its previous trend. In this case, it's the uptrend. The moment to enter a position is when the trend line gets broken. If the breakout point is on the upper line, this is a buy signal. Likewise, if the bottom trend line gets broken, this is a signal to enter a sell position. A stop-loss order in this example should be placed on the level of the lower triangle line, while a take-profit order should be set at the level that reflects the triangle height. The next pattern we will examine is non-symmetrical, i.e. a right-angled triangle pattern. In this pattern, one of the two trend lines is horizontal, so the triangle can be asymmetrical, facing up or facing down. In this case, we have two possibilities. The upper horizontal line could be broken, which signals an uptrend, or a lower horizontal line could be broken, signaling a downtrend. On the picture to the right, we can see how to set the stop loss and take profit. The stop loss in this case is very small and is defined by the ascending trend line. Take profit is set in relation to the triangle height. Aside from triangles, the head and shoulders pattern is also commonly used. This pattern is quite popular when trading shares and consists of 3 consecutive tops, out of which the middle one is the highest, while the other 2 are approximately the same size. Side tops can often differ in size. In this case, we call this pattern an unbalanced head and shoulders. However, this type of pattern can give a clearer and even faster signal for a change in trend. This is how it looks in practice. 3 tops, a head and shoulders. Here we have a so-called neckline that connects the bottom point after the first and the second top. This line will provide us with the breakout signal. If breakout occurs at the right shoulder, the price will drop, and this is the signal to enter a sell position. It is recommended that the stop loss be set at the level of the previous top, while take profit is set in relation to the height of the top of the head. Also, there is a reverse head and shoulders pattern that can signal the end of a downtrend. It follows the same logic, but instead of 3 tops, we have 3 bottoms. The last 2 patterns we will look at are the double top bottom and triple top bottom patterns. They serve as a confirmation of a support line or a resistance line. They serve as a confirmation of a support line or resistance line. In the case of 2 consecutive tops, we draw a horizontal line touching the bottom point between the 2 tops, and this line indicates a breakout point. When a price breaks the breakout line, we enter a sell position and measure the height of the previous top to determine the take profit level. Likewise, the double bottom functions in a similar way, but we have 2 consecutive bottoms. If we connect them with a line, we will get a support level. If we draw a breakout level in the same way, a horizontal line touching the top point between 2 bottom points, the breaking of this line will signal that we should enter a buy position. A similar approach can be applied to the triple top bottom pattern you can see here. So we have 3 consecutive tops and 2 consecutive bottoms. If we connect the 3 tops with a line, we will get a resistance level. The breakdown line connects 2 consecutive bottoms. When it's broken, we should enter a sell position, and vice versa, as can be observed from the picture on the right. This also applies to a quadruple top bottom, as long as the breakdown line isn't broken. I hope you found this video on trading patterns useful. Please join us again at Fortrade soon.